Brian Jacobs, Direxion is well known for its leveraged ETFs, but now you're teaming up with ValueLine for some strategic beta ETFs. Why the shift?
Greg, at Direxion Investments, we've sought to help individual investors take advantage of some of the great research organizations in the United States, ValueLine being just the latest of those. And what we're doing is using their research capabilities to create a strategic beta ETF that allows investors to take advantage of 85 years worth of investment research history. So we've worked with ValueLine to create 3 new indexes. One that invests in dividend-paying stocks in the small to mid-cap range. Second, dividend-paying stocks in the mid to large range. And then thirdly, just a pure portfolio of more conservative equities, those with less risk, less volatility than the average S&P 500.
Let's take it one by one. Talk about that small to mid-cap, high dividend, ValueLine ETF. The names just keep getting longer.
Right.
What makes this one better than the competition?
Well, first off, and the symbol on that is VLSM. That's the small to mid-cap strategy. First off, it has a very attractive dividend distribution yield on it. And history shows, based on ValueLine's research, that those securities that pay a consistent dividend that's sustainable and timely can generate attractive total returns over time. So we've created a strategy that allows you to do that. And for investors that look in the small to mid-cap range, they'll know it's hard to find a good active manager that's open to new money. So this is a rules-based index approach, so it's not active, but it does utilize the research that many active managers consider. So at 58 basis points, total expenses, we feel this provides a very attractive, cost-efficient way to get exposure to the small to mid-cap range and get an attractive yield while you wait for that return.
Is it the same fee and the same parameters for the mid to large cap, high dividend ValueLine ETF?
Yes, 58 basis points total expenses on that as well.
And that's going to compete with a lot of other big ones out there. How will it handle the competition?
So the strategy for VLML, which is the mid to large cap, is designed to provide an attractive level of income. And again, based on ValueLine's 85 years worth of research. So as we've gone and looked at the back test on this performance, it shows that by applying ValueLine's consistency and timeliness, those securities that represent the highest ranking among consistently and timeliness, we generate a much better total return in the index. And we've created an ETF based on that index.
And then finally, there's the conservative equity ETF. This is your VLLV. Right. Nice little palindrome for a ticker. Right. So tell me why this one is going to be better than the other conservative ETFs out there.
Right. So the strategy here is if you think about the average age of an investor in the United States that buy ETFs and mutual funds, it's about 58 years old. And for many of those clients, they're in the participate and protect mode. That is, I know I need to participate in the equity market because I hope to live 30 or more years from now, but I don't want to outlive my money, so I know I need to participate in equities. So they need to be there. Yet at the same time, they want some protection on the downside. So is there a way for them to participate, but do it in a more conservative, less volatile way? What ValueLine's put together is based on their rankings, is come up with the least volatile, less risky names in a portfolio and created this new ETF based on that.
All right. Thanks a lot, Brian.
Greg, it's great to be here.
Thank you for watching The Street.